G'day members and welcome to our macroeconomic catch-up. My name is Mitchell Snedden and of course I'm joined by Callam Pickering. Now Callam, happy National Accounts Week. Now firstly for our members who are unaware, what is National Accounts Week and what does it actually mean?
Well, the National Accounts is basically a stock take of the Australian economy over a specific period of time, in this case over a 1 quarter period. It gives us an idea of how the economy is tracking compared to the past, so it gives an indication of economic growth. It also breaks things down into various sectors, as well as industries as well. So it provides a lot of information that we don't otherwise have and allows market participants to get a better feel for how the economy is tracking.
Well, before we look forward, let's have a look back. The last September quarter results, they were negative. If we get two negative results in a row, technically we're in a recession. Is that how you see it?
Well, the good news is we're going to avoid a recession, or at least that's what the market expects. Current market expectations are for growth of around 0.7%, which would see the economy expand by around 1.9% over the past 12 months. I expect a slightly weak result, around a 0.5% quarterly result, but again, we're going to miss a recession. So we don't need to worry about that for now. That said, if you've got an economy that contracts by 0.5%, then an economy that expands by around the same, you've got 6 months, you haven't really seen any growth at all. So we do have quite a weak economy, even if we do miss a recession. So there are a number of issues there that we need to work through, and hopefully that situation will begin to improve over the next 12 to 24 months.
Well, I guess as well, investors can look at the market, because as we always say, markets are forward-looking. Because we've been in such a buoyant a market for the last number of months, is that a clear sign to investors that we're not in that recession kind of danger?
I think that's quite accurate. The market really took that weaker result in its stride. It didn't affect it too much, which suggests that the market interpreted it as being a transitory or temporary outcome and that they expected the economy would rebound in the December quarter. As I said, market expectations are around for a 0.7% result. The market has priced that in. So depending on what happens when the data is released on Wednesday, we will see some revision to the market. So if we do get a stronger than expected result, then naturally you'd expect the market to be a little bit higher than it otherwise would be. Vice versa if you get a weaker result.
So a change from 0.5 to positive 0.7 seems like quite a big change on a quarterly basis. If the market, if we don't hit those expectations of 0.7 and we fall short, are we in fear of maybe a little slight correction or even some heat coming out of the market just a little bit?
It's certainly a possibility, but over the past 3 months or so, most of the market action has been driven from the United States, particularly with regards to President Trump and the expectations surrounding his fiscal policy, his tax plan, his infrastructure program. So most of the strength has been regarding that. That said, if the GDP result does fall short of market expectations, you would expect some weaker price action there. That's quite common, and naturally I would expect that to be the case.
We won't talk about Trump at all. He's already gotten too much time in this room. Let's go on to, you mentioned the national accounts. We'll be seeing sector by sector results. What are your expectations? Where do the strengths lie? Where do the weaknesses lie?
Well, it's going to be a really interesting quarter because we have this unusual dichotomy between what's happening in the trade sector. So the monthly international trade data indicates that we have the largest trade surplus in Australian history. And it's improved pretty much over just the last 3 months. So you naturally expect that to contribute a lot to real GDP. The problem is it won't. And the reason for that is because of the price changes with regards to commodity prices. So the value of trade has increased significantly, but the volume of iron ore and coal that we've been trading actually hasn't increased at all. So we're going to have net exports contribute a great deal to nominal GDP, which is going to be a really strong result, but it's actually probably going to contribute negatively to real GDP. So that, I think, is a weird situation where it's both a strength and a weakness at the same time. It's a very unusual result and it's going to be quite difficult for most analysts to interpret.
So what are the longer term implications for investors if we see these higher commodity prices yet lower volumes continue?
Well, based on what we've seen over the past few months, the market has interpreted it naturally as a pretty good result for the resources sector. Anytime income and profitability increases, that's really good, even if what's happening is subtracting from real GDP. So For now, it's certainly going to be a positive interpretation. If commodity prices do begin to come off, then I think the market will switch very quickly, even if you do see volumes increase, which is quite common. But for now, it's certainly a positive development for the resource sector.
It is interesting to note that a lot of the active managers out there and a lot of the bigger names are still well and truly underweight resources when they're taking a longer term view. So they've had some short term pain at the moment, but they are taking that longer term view and are short.
Yeah, most market analysts believe that commodity prices are going to come off pretty steadily throughout 2017 and 2018. They believe that some of the strength that we saw throughout 2016 was merely temporary. And I think there's an element of truth there. A lot of it was supply related, coming from China, and they expect that to correct itself. And once that happens, you would expect prices to return to lower levels, maybe not as low as it got throughout the 2015 period, but certainly much lower than it is now. And of course, if that happens, then naturally the share price of most of the resource sector firms will begin to moderate and justify what a lot of fund managers are doing right now.
And so you are on the same side as those fund managers, longer term materials and commodities investments? I
think so, yeah. What we've got at the moment is we continue to see a significant oversupply in the market when the market is operating properly, which it hasn't been for some time now. So once the market does begin to normalise, we will see supply outstrip demand, and when that's the case, commodity prices fall.
Now, going back to the national accounts, where do you see what sectors do you see as the major source of strength right now, and how do you see them developing over the next 2, 3, 4 years?
So household consumption is going to be the major source of strength for the Australian economy in the December quarter. Now, whether it remains that way over the next year or two is, of course, the billion-dollar question, because household consumption accounts for around 55% of real GDP. So if you've got a strong household sector, the economy is usually going to perform pretty well. But if you've got a weak household sector, naturally the economy is going to be somewhat weaker. I think the big challenge for the household sector is going to be the ongoing weakness in wages. We saw last week the wage price index came out, private sector wages growing at their slowest rate in at least 25 years, up by 1.8%. And you've got to suspect that over time that's going to constrain households and what they can spend. So naturally I would expect some of the strength in household consumption right now to maybe moderate a little bit over the next couple of years, and that presents another challenge for the Australian economy.
And if we extrapolate that into a market sense, you're probably looking at the consumer discretionary space feeling the pinch a little bit there?
That's usually the way it works, yes. When household budgets are tight, non-discretionary spending usually remains quite strong, so things such as food, always pretty good, but a lot of the household goods, things, or recreational spending, things such as that usually come off a little bit.
Excellent. Well, Callam, thanks for joining us, and members, we'll catch you next week.